Regardless of volatility in the overall market, one place you can always count on volatility is when a company has earnings coming up. And with this volatility comes increased option premiums, which make earnings a great option selling opportunity. To take advantage of this, we've developed an approach that has one of the single highest success rates of any option selling strategy we use. We call it the 10-day trade, as it gives you 3 opportunities at a profit in a roughly 10-day period. How does it work? Let's get into it. Welcome back to the Hourglass Trader, where as time passes, we make money. To start, you're going to want to pick a stock that has earnings next week. So if we consider this the current trading week, you'd want to select a stock that has earnings this week. Additionally, this is a neutral to bullish strategy, so you're going to want to pick a stock that you think will perform well for earnings. So let's start with the first step of finding a stock with earnings that are not this week but next week. And to do this, we've quickly built out a scanner that pulls up a stock with earnings in the next 10 days but not the next 5 days. And we could put this in here by loading in the HT 10-day stock scan. And as you can see right there, we've got the 2 filters within the next 10 days, but not within the next 5 days. So that'll give us stocks with earnings between 5 and 10 days from now. And you could also find that and import it into your Thinkorscan module by going to our website and navigating to the option scanners page. And if you scan down, you're going to see it right there, the 10-day scanner with the link on the arrow. So there we have it, but again, it's not that complex of one, so you don't need to either use Thinkorswim. You could just quickly rebuild it by, using whatever scanning tool that you use to have these 2 parameters in there. And one quick distinction I want to make is that right now we have it between 5 and 10 days because it's currently Wednesday, right? So if we look 1, 2, 3, 4, 5, that gets us to Monday. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 gets us to the back end of the week. So while this is kind of the default time period that we have in there, 5 and 10 days, if it were Monday, you would need to adjust these parameters to 1, 2, 3, 4, 5, between 6 and 7, 8, 9, 10, 11, or 12. So between 6 and 11 or 12 as opposed to 5 and 10, depending on the day of the week. But that's just a small point. So let's run the scan and see what stocks that it spits out that fit that time frame of stocks that have earnings not this week, but the following week. And there you have it. We have about 247 results. We like to sort these by RSI in ascending order. But that's just because, we're big believers in RSI and thinking that when things are oversold, they're kind of bound to bounce. But you could view these however you want. Bottom line is we have 247 stocks that are coming up that kind of fit the bill for what we want to do for this 10-day trade. And right at the top, we have Netflix, very popular stock. So let's use that as the example that we're going to push through as we talk about how this trade would work. So we mentioned at the top of the video, there are 3 different ways or 3 different opportunities to have profit during a 10-day trade. And the first is the very first trade that you make the week before earnings. And that trade, if we look at Netflix, is going to be selling puts dead at the money. So if we pull Netflix up into here really quickly, we're going to see that it's trading at $538.14. So we don't want to go 540 because that's slightly in the money, but what we would consider at the money for this week is going to be the 535 strike, which are going for about $4.50 a piece. So just off the bat, we have our very first chance of making profit in this 10-day trade. If Netflix stays above 535 this week, we're going to take home a profit on the trade. Now, why do we want to sell at the money? And the answer, courtesy of this peer-reviewed paper from the National Bureau of Economic Research, is that stocks actually tend to rise around earnings announcements. So, if you had a given week, you could theoretically say that, maybe there's a 50-50 chance a stock goes up or a stock goes down. However, there's actually a slightly greater chance that around earnings announcements and the week before them, the stock's going to go up. So while we set up a trade that theoretically should be 50-50 if stock goes up or if stock goes down, we actually have a little bit of an edge in our favor since historically stocks tend to rise before earnings. So that's option number 1 that we have to profit, just if Netflix finishes above 535 for the coming week with this at the money put that we sold. And we also want to keep in mind that it is Wednesday today. We typically would want to open these on, Friday of the previous week or Monday, so we get a full week, and these returns would normally look a little bit bigger, but for the sake of the example, we're going to move forward with these prices as they currently exist on Wednesday. So as we've laid out, if it finishes above 535, we're going to take home a nice profit. But, we always want to talk about the downside risk. What happens on step 2 of this trade if it finishes below 535? And the answer is we know that the 535 puts are going for roughly $4.50 a piece. We know that our break-even price, if assigned to these shares, would be 535 minus 450 to get us to a $530.50 break-even price. So from there, if we take a look at the 1-year chart, that would get our break-even price if if I select the drawing tool really quickly, $530.50, which is roughly right around this level. Let me extend that to the left really quickly. And there you have it. So our initial step one of the trade, this is our break-even price. So what if it finishes below 535 and we have to take assignment of these shares? Step two is selling covered calls for earnings week. So if we minimize all these, we could see, the implied volatility at each given week and the expected move here. For the January 14th front expiry options, there really isn't that big of an expected move. And that's because there aren't earnings where, when we see this January 21st, 2022, Netflix is reporting earnings on the 20th, which falls on next Thursday. So since the earnings are next week, there is much more of an expected move, meaning there's even more option premium. So we take our 530.50 basis, which is already advantageous as compared to the current price of 538, and we're going to sell what is an at-the-money call. And if you look at the at-the-money calls here, they're offering roughly 21. Since that's a little bit in the money, we could call it conservatively $20 of premium at the money. So what do we know about our break-even price when we sell a covered call for $20 of premium? And the answer is that it decreases by 20. So our break-even price that we had here at the front end of the trade at $530.50 is then subsequently decreased by $20. And that's going to get us down to $510.50. So there we go. This is our step two break-even price. We're going to extend that to the left as well. So again, step one of the trade, we sell at the money puts. That has a greater than 50% chance of success due to the typical behavior of stocks before earnings. But if it doesn't, that's okay. We'll have shares with an advantageous basis of $530.50. Step two, if it does go down below that 535 strike we wanted to initially sell, we take assignment of those shares. We sell an at-the-money call with inflated premiums because it's earnings week, and that's going to knock another $20 off of our break-even price, which gets us down to $510.50. So from here, we just wait and see how earnings play out. If Netflix holds above 510 on earnings, which we have a decent cushion between the current price and 510, we'll win the trade. That's our second opportunity to win the trade. We'll close out those shares. We'll let those covered calls expire worthless, and we'll move on to the next one. But step three, again, keeping this downside risk in mind, what if it does break below 510? The answer is, since the earnings are on Thursday, Friday morning, we would close the covered calls that we sold at 535 strike, theoretically, and then we would roll those down. So if Netflix tanked after earnings and went down to 500, the original 535 calls that we sold after earnings are really not going to be worth much. We'll probably be able to close those and lock in maybe $18 or $19 a premium. And then from there, after earnings, implied volatility typically stays relatively high. So we'd be able to go with another potential at-the-money put, or at least sell it near our cost basis at 510. And then we presumably be able to collect maybe $5 or $6 more of premium. That's a little harder to play the theoretical game on because that, is 2-3 steps beyond the trade and depends a lot on where the price settles for Netflix after earnings. But the point being, with that step three, we can get our break-even price maybe $5 or $6 lower, down closer to $500 a share. So let's recap here really quickly so that we're not leaving you looking at a chart with a bunch of red lines that may or may not make sense. Let's walk through the 3 steps as we presented them in this video. Again, that first step, Netflix was at 538 when we began the video. That first step was to sell an at-the-money cash secured put for a $5 credit, which a 535 strike that we proposed would have a $530.50 break-even price. And then the second step, assuming it's necessary Netflix drop below 535, would be to sell an at-the-money covered call after taking assignment of the shares with that 530.5 break-even. The hypothetical credit here would be about $20 of credit, which would get your break-even down to $510.50. From there, after step 2, you sit back and wait for earnings results. This is another event that we view as somewhat binary in the sense that, either earnings are going to be good, the stock's going to shoot up, and you're not going to have to worry about this again and take home a gain, or the stock's going to go down, at which point you'll launch into step 3, which is closing out the original covered call that you sold and rolling it down at the money. And I know a second ago we said maybe a $5 or $6 credit hypothetically, but after looking back at a couple past examples, I think 10 might be a little bit more realistic for the fact pattern that we're looking at here. So in conclusion, you've started playing Netflix at 538. You have a break-even price by next Friday of $500.50, which basically gives you a 6.97% credit. So in plain English, you could do all of this, and just as long as Netflix doesn't drop 6.9% in the upcoming week, you are going to take home a profit, and that is the 10-day trade for earnings. And one other quick item to address is you might say, okay, at the end of this trade, our break-even price is roughly $500. That's a decent cushion. But HT, if I go to the option chain for January 21st when the earnings are occurring, I could take a look at these option chains, look at 500, and see that you could get some decent returns below 500. So I could launch into a trade where I get, $4 of premium at 485 and give myself a lower break-even price. So you might say, hey, why don't I just go ahead and do that? The answer is that for something at this price level, you're getting a roughly $4-ish premium. If we look back to the current week, you could see that, these are a little bit lower because it's only, Wednesday, as we mentioned. Premiums would have been higher on Monday, but even with this first step where we're selling the at-the-money cash secured put, we're already getting more premium than that. And that kind of gives us a quick 50-50 chance on the front end to get a quick profit without even having to worry about earnings. And the thing about these premiums are that since earnings are next week and the premiums on these options are inflated because of that pending event, after this week, this premium isn't going anywhere. If we do the front end of the 10-day trade right here and we walk away because Netflix finishes above 535, one, we're going to take home that roughly $5 credit. And two, we could launch into that same earnings trade at 485 or 490 if we wanted to, with the advantage of already having collected $5 of premium from the front end of the trade. So that's why we take this approach of having this first step before the actual earnings trade as part of our 10-day trade for earnings, as opposed to just jumping directly into the earnings trade. For more info on what we do and some more option selling tips and tricks, head over to hourglass-trader.com. From there, you'll have links to join our Discord server and potentially sign up for HT Premium, which is the premium service we offer where we alert our trades and just provide some general additional value. But at the end of the day, these YouTube videos, the strategies that we teach are always going to be free to learn. That's the goal with the channel. So if you've stuck with it until the end of the video, thanks for watching. Feel free to subscribe if you haven't yet. We stream on Twitch every single Sunday at about 9 p.m. So if you're free around that time, feel free to join us on those as well. But until next time, this has been the Hourglass Trader, where as time passes, we make money.